Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 6th of June. I'm Daniel Lam, your host for the podcast. One of the major changes in our most recent global markets outlook was the upgrade of Japanese equities to overweight. Now, we spoke about Japanese equities as recently as yesterday's podcast, citing the valuation discount versus global equities and the improving corporate governance acting as a key catalyst for outperformance. The most frequently asked question on this upgrade, from internal to external clients alike, is whether a strengthening Japanese yen may hurt the rally in Japanese equities. And our view is a no. Despite this most cliche expression in finance, i.e., this time is different, the driving force of this improving corporate governance comes from Tokyo Stock Exchange, and therefore it is likely to have legs. This, combined with the long-term depressed valuation in Japanese equities, means that investors may look beyond the potential negative impact from potentially strengthening yen on corporate earnings. And how do we see Japanese yen going forward? Well, we believe that the recent bout of Japanese yen weakness is an opportunity for investors to add exposure to the currency at attractive levels. The rise in dollar yen, or yen weakness, since the middle of March this year has been driven by a combination of a rise in US government bond yield and markets pricing out the likelihood of a shift towards a tighter BOJ monetary policy. But we do believe that the market reaction is now looking overdone. We expect 10-year US government bond yield to decline below 3.5% over the next 3 months and eventually drop below 3% in the first half of next year, as the Fed may start to cut rates in the fourth quarter this year. This should drive interest rate differentials between US and Japan lower, pushing dollar yen lower or leading to yen strength. We also believe the pressure on the BOJ to ultimately scrap its extremely dovish yield curve control policy and take Japan's benchmark interest rates back to positive territory remains in place. Last week, Japanese officials had an unscheduled meeting and stated that the government would provide appropriate response to the Japanese yen weakness if necessary. These comments raise the risk of a government intervention to prevent excessive weakening of the Japanese yen. From a technical perspective, we see 142.35 as the near-term resistance for the dollar yen, with 137.25 as the immediate support. We're expecting dollar yen to decline towards the 134 to 135 mark over the next 3 months. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.